All right, welcome. Today we are going to break down a complete step-by-step Fibonacci scalping strategy. We're talking about a method for grabbing quick profits from those small market swings. There's no fluff here, just a really clear method that's backed by 100 back-tested trades. So you're going to see exactly how it works, why it works, and maybe most importantly, when it doesn't.
So let's get the big question out of the way right up front. Are these Fibonacci levels some kind of magic? These mathematical ratios that pop up everywhere in nature? Do they have some kind of mystical power over the markets? It's a fair question, especially when you see how often the price seems to respect them.
And the answer is nope, not magic at all. It's all about market psychology. See, these levels work because a huge number of traders, we're talking everyone from small retail bots to massive institutions, are all looking at the exact same levels on their charts. It basically becomes a self-fulfilling prophecy, all grounded in shared human behavior.
So here's our game plan for today. First, we'll get into the secret sauce, why this thing actually works. Then I'll give you a simple 5-step checklist to find the perfect setup. We'll cover how to place the trade, the 3 big scenarios you need to avoid, and then we'll wrap up with the hard data, the back-tested proof.
Okay, let's dive right in. What's the core idea that really makes this entire strategy tick? Well, it really all comes down to this one concept, the golden pocket. See, markets almost never move in a straight line. They make a strong push, and then they have to pull back, right? That pullback is where traders hesitate, and others look to get in. And that zone, right between the 0.5 and the 0.618 levels, is where tons of liquidity builds up. It's a hot spot where the big players often step in, and that gives us a really high probability area to make our move.
Okay, so that's the theory, but what's really cool is how we can turn this into a system. So let's get to the actionable part, a super simple 5-step checklist you can use to spot a valid trade. Now, this slide is absolutely crucial. You might want to grab a screenshot of this. First, you need a strong, obvious push in one direction. That's your impulse move. Second, and this is non-negotiable, that move has to break a previous high or low. That confirms the trend is strong. Then you draw your fib tool from the very start to the very end of that move. You patiently wait for the price to pull back into our golden pocket. And finally, you look for your entry.
Okay, so you've used the checklist, you found a perfect setup. Now what? Let's get into the nitty-gritty, the exact parameters for actually placing the trade. First things first, simplicity is your best friend here. We're getting rid of all those extra Fibonacci levels that just clutter up your chart and create noise. You only need these 6, the 0 and 1, the 2 levels for our golden pocket, and then a couple of negative levels we can use as profit targets. That's it, nice, clean, and focused. And this right here lays out the entire trade for you. It's beautiful. Your entry is a limit order set at the 0.618 level. Your stop loss is tucked just beyond the start of the whole move, at the 1 level. And your take profit, that's aimed right at the recent high or low, the 0 level. What this does is it gives you a consistent 1 to 1.6 risk to reward ratio, which, trust me, is absolutely vital if you want to be profitable in the long run.
Now, any good strategy is just as much about managing risk as it is about making profits. So let's talk about something critical, knowing when this setup is likely to fail and when you should just, sit on your hands and stay out of the market. And here it is, the single most important rule of them all. If the market is just moving sideways in a messy, choppy range, you do not trade. End of story. This strategy absolutely needs a clear trend to work. Trying to draw fibs on random market noise isn't trading, it's just gambling.
Let's break that down into 3 specific times this strategy will fail you. First, like we just said, no clear trend. Second, high-impact news events. A surprise interest rate decision can cause a massive price spike that will blow right through any technical level you have on your chart. And third, low volume periods. Outside of the main market sessions, the price action is weak and it's just full of fake outs.
So we've got the theory, we've got the rules, but does it actually hold up under real-world pressure? Let's take a look at the back-tested proof. So this strategy was put to the test 100 times on the euro/US dollar pair. And the results were pretty compelling. A 62% win rate and a net profit of over 25R. What that means is, for every dollar you risked, the strategy returned 25 over those trades. But here's the critical part. These trades were only taken during that high-volume window, from the London Open to the New York close. And this slide right here perfectly shows why that timing is so critical. During the London and New York sessions, especially when they overlap, you've got all the major players trading.
That means high volume and those clean, trending moves that this strategy absolutely loves. Compare that to the Asian session, which is often just choppy and sluggish. Your trading session is your edge.
So, what's the big takeaway from all that data? Well, that 62% win rate shows you that profitability doesn't come from some magic strategy that wins every single time. That doesn't exist. It comes from having a statistical edge and then having the discipline to apply it. That positive win rate, combined with our solid risk-to-reward ratio, is what produces gains over the long term, consistently over and over again. And that really brings us to the final and most important point of all. The strategy itself, as you've seen, is incredibly simple. The rules are crystal clear. The real challenge isn't understanding the charts, it's in the execution. So the real question to leave you with is this: is your discipline strong enough to follow the rules trade after trade?